they just released recently. So those are Amazon. I think they
What
have
flavors?
I think that it's just two flavors. I think for now, if I'm not looking at it, but I think it's cookies and cream and salted caramel. At least that's
Salted. I think it's salted caramel peanut butter.
could be. So I think it was. I mean, they're not like cheap. I think it was like $14 for a box of six. But what's ironic is I usually eat a lot of those kind bars. I think it's the dark chocolate and cherry kind bars, and I order like 2 or 3 boxes a month off of Amazon. And they just emailed me yesterday morning and said because of the hot weather, they are no longer going to be shipping those kind bars in the summertime because they melt, which is true. The last couple of boxes I've gotten, the chocolate's like all melted inside. So good timing for Celsius to come out with their protein bars. So, I mean, Celsius is having a phenomenal day, a new all-time high, got up to like 75.50, up 13% today. We broke through the highs from a few months ago, which was around like 70.50. So as soon as the stock cleared 70.50, I posted a chart of where I think the stock can go in the next few weeks, maybe month. And you can see that on Twitter right now if you want on my Twitter account. I think the stock probably goes to 85.90 in the next month, maybe month and a half, going into Q2 earnings, which I've been pretty vocal about saying I think they're going to crush the numbers just based on what we're seeing from the Nielsen scan data. So, I forget if I talked about this 2 weeks ago. I'll just go through it real quick. The company Celsius breaks out their revenues between U.S. and international, and the Nielsen scan data for Q1 was tracking about 100% year-over-year growth for scan data in the U.S. And then when they reported earnings, Q1 earnings, U.S. operations were up 101%. So the Nielsen scan data like nailed it on the nose. And then international growth was up like 25%. So you blend it all together and revenues were up 78% year over year for Q1. Now you get into like the first 6 weeks of Q2, which is April and the first 2 weeks of May, and Nielsen scan data is like 200% year over year. And if it plays out the same way and US operations end up putting up 200% year over year growth, and then we should see a better rebound from international, so maybe 40-50% year over year. I mean, Celsius could just demolish estimates right now for Q2, which are only 53 million. I mean, they have a very good shot of just blowing that number away and doing maybe 70 million in the quarter. The only thing that could really slow them down is the transition from DTR to DSD, which is still going on. The branded coolers, how quickly they can get those into stores, and then this aluminum can shortage, which the entire industry is facing. So Celsius is my third largest position right now, and it is not far behind my top two positions, which are FUTU and Upstart. So my top four go FUTU, Upstart, Celsius, Durham Tech, and then it's Atarian, Desktop Metal, Dario Health, and ClearPoint. So those are my top 8, and then it like really drops off after that.
So you also had mentioned to me that you were holding FUTU calls. Have you closed out any of those positions?
Yeah, I sold the FUTU calls last week with like 150 or 200% gain. I own so much of the stock right now that I'm just not really sure I need FUTU calls. But what I did was I sold the FUTU. So I sold my Upstart calls up like 550%, rolled those into FUTU calls, sold those at like 150%, and then rolled those into Durham Tech calls. So, Durham Tech right now, what's that account on Twitter? Fuck, hold on. Zero Hedge, right? Or Hedge Zero. I forget which one it is.
Zero Hedge, yeah.
Zero Hedge. They just posted a list of the most shorted stocks out there, or the stocks with the highest short interest. And Durham Tech, despite the fact that they're trying to save lives by, detecting skin cancer as early as possible, there's like a 30% short interest. They're actually showing almost 33% short interest on this chart. I mean, if we get one big insurance announcement from Durham Tech, which could come at any point from a Cigna, a United Health, any more of the Blue Cross Blue Shields. I mean, there's a lot of insurance companies out there. If any of them come out to start supporting Durham Tech, I mean, this stock could rip 30, 40, 50% in a week. So I have July 18th expiration, strike price 50 calls on Durham Tech, and I actually added some this morning. So I don't know for sure if we're going to get an insurance announcement between now and July 18th, but I wouldn't be shocked.
Interesting. Looking at those prices right now. So that's the July 18th one.
Yep.
So you're going, okay. I see for July 16th
July 16th.
when they're off.
Yeah, July 16th.
Okay, July 16th, $50. Yeah, it's trading at 228 right now.
Yeah. June 18th is when is the FUTU calls I sold, and then July 16th is the Durham Tech calls that I bought.
Okay, cool, got it. Within, I guess, bringing it back to Upstart, this was kind of a good question that came in, which is, Upstart obviously ran a ton. I actually sold like half my position at the top right there at 170, which I'm glad I did because it did pull back. When do you start trimming? What kind of is like the percentages you look for, indicators where you're like, okay, something's run a bunch, I'm going to trim here?
Oh, I trim. I mean, as soon as it got back up to like 160, I started trimming. So, because I almost doubled down in the 90s, and then I kept buying down into the 80s. So, I mean, it was a very significant position in my portfolio. So as it basically went up 100% in the next week, where I think it was like 6 or 7 trading days, the stock was up 100%. I mean, I would have been an idiot not to start trimming, but I'm not going to post all my trims on Twitter. That just doesn't make any sense. But oh yeah, I mean, as soon as it got back up, and maybe it was like, I think maybe when it got back up into the 150s, I started trimming. So like I'll trim, so maybe at like 150, I trim 2%. At 152, I trim another 2%. And like literally, I would just set limit orders, every $2 higher, I would trim another 2% of the position. So, I had no idea how far it could go or when it might pull back. I mean, it had such an amazing run in those 6 or 7 days. I felt like it could pull back at any point. I wanted to take some profit. So, I mean, it rallied all the way up to, like you said, like 170 something. So by the time it got up into the 170s, I had probably trimmed 30% of my position. And then when it dropped the next few days into the 140s, I started buying those shares back. So I even went in this morning, and I mean, yesterday I bought some more Upstart. Today I bought some more Upstart. So my cost basis keeps going up because I just keep adding to the position. So it's FUTU. I've done the same thing. I mean, when FUTU dropped down to 100 a month or so ago, I mean, I doubled down on the stock, and then it ripped up to 140, and I started trimming. So just because these are core positions doesn't mean that I'm not going to trade around them, especially when they do what I think they're going to do. And, they rally 30, 40, 50%, and then the position just becomes too big for my portfolio. And I have to start reducing it for the sake of risk management.
Okay, I hear that. All right, I'm going to take us a side topic for maybe we'll do just a few minutes on this, but that is the craziness that is going on in the meme stock world being run. AMC is basically at 100% gain today, sitting at 550% over the past month. Everything else is up with it. GME, BlackBerry. Maybe what are some of your thoughts on this and just how it's going to continue to move forward as just we've seen, I think institutional ownership in AMC is 26%. So they have 74% retail, and they're clearly moving the stock. And just kind of your thoughts on this overall.
I mean, a lot of AMC insiders have been dumping the stock the last few days, and I don't blame them. I mean, GME is up 6,000% over the last year. And the stock got up to 483. So now it's at 275. So, I mean, it's almost 50% off of that all-time high. But I mean, still, like GME at a $20 billion market cap, not including any debt. Let me just see how much debt they have. Okay, they don't have much debt. So, but still, I mean, GME is not worth $20 billion. But AMC has become even more ridiculous because, I mean, like you said, the stock's up 100% today. Obviously, the stock's up 1,000% year to date. The market cap, I believe, this morning got up to 30 billion. I think they have at least another 10 billion in debt. So you're talking a $40 billion enterprise for a movie. I mean, I don't know. I mean, I haven't been in the movies in like 5 or 6 years. During the pandemic, you hear all these, companies, Disney and others saying that they're going to start shortening the window for new releases so that there's, even less exclusivity for the movie theaters. I mean, there's nobody could convince me that the fundamentals justify AMC at $68 a share. But we don't live in a world all the time of, where fundamentals are driving stock price. It's, short squeezes, it's momentum, it's Reddit, I mean, retail options. I mean, there's a lot of different factors. So, I mean, you couldn't pay me to buy AMC at $70 a share right now. But I also wouldn't short it. I mean, I did look at some put options today to see if maybe it made sense to buy some put options, and they're just really, really expensive. And I don't think you could even borrow the stock. I've seen a couple people posting that the stock's not even, you can't borrow it from like Fidelity or almost any other broker out there. So I don't know. Like, I mean, the people that are short the stock right now, it's not like they can, they're getting their asses kicked, obviously. I mean, it's hard to believe after the whole GameStop thing that any hedge fund would be dumb enough to take a massive position in one of these Reddit stocks. But if they wanted to double down on their position, they can't even do that unless they're going to go naked short. And then they're just really, really opening up Pandora's box for some hurt. So I don't know. I mean, I don't understand it. I can't believe that people would I, I don't know. My hard-earned cash, there's no way in a million fucking years I'm putting my hard-earned cash into a Reddit stock, and buying AMC, BlackBerry, any of these other ridiculous names that make no sense. I mean, it's gonna end bad. I don't know when. I don't know if it's tomorrow, next week, next month, or next year. It will end bad. Anyone that's buying AMC at $65 or $70, if they think it's going to 100 or 200 or 300, I think they're wrong. It could. GME did it. But I mean, a year from now, I'd be shocked if this stock is still above $30. But we'll see. We'll see. I'm not playing around with it. That's for sure. I'll let everyone else do it.
The volatility is insane too. When I asked you that question, it was up 100%. Halfway through your answer, it was up 125%. It fell all the way back down to no gain, and now it's back up 15%.
Yeah. I mean, the numbers are absolutely bonkers. And to be honest, I think it's irresponsible for CNBC to be talking about these stocks every 15 minutes. Because every time, I was watching Fast Money earlier, and they spent 5 or 10 minutes talking about, all of these Reddit stocks, and they just started ripping higher. And that's where retail is just going to get themselves in trouble. So I don't know. I mean,
Right.
there's a lot. I mean, I missed the crypto craze. I missed Dogecoin. I mean, there's a lot of these stocks or assets that I just have no interest in. I mean, because if if I disclose that I'm getting into one of these things and shit hits the fan, like it probably will at some point, I look like an idiot. I ruin my reputation. My credibility goes down the drain. It's just not worth it for me.
Right. Especially, yeah, 100% with your platform. All right, shifting gears again. Let's dive into Ethereum. And I'm just looking real quick. That's ATER for everybody who's kind of following along with us. They are back up to $18 per share. They had fallen all the way down to around 12. I did buy some down there around like 14. But they're still obviously pretty far down, but they bumped off of 12. So maybe you can talk about their moving averages and just kind of like your thoughts on the stock right now.
Yeah, I mean, so this is well, it's a somewhat heavily shorted stock. Let me see if I can pull up a number right now. Yeah, I mean, I think short interest. I mean, on ticker, it's showing 14%. I think I've seen it as high as 20 or 25%. But clearly, the stock. I mean, when it got up into the 40s, it was the shorts came after it, and they should. I mean, the stock was clearly overvalued at $48 a share when I wrote about it in December at 12, and then, like we know, it went from 12 to 48, and then all the way from 48 back down to 12. So like you said, it's had a nice 50% bounce off that bottom. For I think a lot of people, including myself, probably have a cost basis in the mid 20s, high 20s, low 30s. I think my cost basis, well, I'm looking at my screen right now, it's $24. So, I mean, I'm still underwater. This is actually my biggest unrealized loss in my portfolio is Ethereum. Second is Durham Tech. But I don't really care. I mean, like, these are stocks that I still plan to own for a while. Atarian had a really nice announcement yesterday where all of their largest insiders, shareholders, former founders, and then the founders and CEOs of the companies that they've recently acquired, as part of their M&A strategy, most of them, if not all of them, agreed to lock up their shares through the end of this year. So we're not going to see any insider selling, because if they hadn't done that, some of these shares could have been sold in the next couple months. And I think investors were worried about that. And now it looks like that's not going to happen. I also think there's a chance that that puts them in a better position to finalize a deal with the tier one bank for a larger credit facility. I mean, there's 3 or 4 private companies out there, including Thrasio. There's one called Perch. They're raising hundreds and hundreds of millions of dollars to basically do the same thing that Atarian's doing. But they're really just pure M&A plays. Atarian has a couple dimensions to it. There's the M&A play, basically doing roll up of Amazon FBA companies fulfilled by Amazon. And there's 6 million sellers on Amazon. So, even though there's going to be increased competition from some of these other, private players, there's plenty of e-commerce brands and companies to go around. But I mean, Atarian has the longest track record out of all of them. They also have the ability to launch their own products and brands, which they've done successfully over the last few years. And then they also have this AI software called Amy that the other ones do not have. And I think, from talking to other investors and people at the company, I do think we're going to get more good news about Amy in the coming weeks or months. So that's a potential revenue source that I don't think is being priced into the stock right now. So it's still a stock that I like. Yeah, it sucks to be underwater on it right now, but I mean, I still, I did an update on the company for my Substack after they reported Q1 earnings, and I made this bold prediction that this could be a 100-bagger over the next 20 years. And if you actually run the numbers, it's not that crazy of an idea. If they can, you know, lock up a cheaper credit facility at, let's say, 5%, and they can keep on buying these companies at 5-6 times earnings, and then strip out 70 to 80% of the fixed costs, which is what they do. I mean, they are just going to keep just compounding those earnings and profits, and this is going to be a cash flow generating machine going forward that they can use for more acquisitions or stock buyback or whatever the hell they want. So I think the story is just getting started. I'm not worried about the bigger companies coming in. There's plenty of meat to go around. E-commerce is a multi-trillion-dollar industry. And then on top of that, if we start to see some of those companies go public, like Thrasio, it's going to make Atarian look even cheaper on a price to sales or price to EBITDA multiple or whatever else you want to use. So I still own it. I mean, I'm not too worried about Atarian right now.
Okay, got that. Question for you on kind of some of the social medias that we're seeing. So the groups that are kind of moving, these stocks where it's retail investors, that's them banding together on social medias. So that's something, like Twitter or Reddit, places like that. Do you see the ability now that people can move these as maybe a bullish sign for some of these stocks, that all these people are coming on here and like moving the market? What if they turned and they were like, oh, we're all doing this on Twitter? What if Twitter became like the next kind of short squeeze, something like that? Could this translate into, the social power being bullish for social stocks?
I don't know.
He says with Twitter 2022 calls in hand.
Yeah, I mean, I don't know. Like, Twitter still seems like a very undervalued asset. But I mean, I don't invest in any of those companies. Facebook's too big, Snapchat's too big, Twitter's too big. I think everyone knows by now, and if they don't, I'll say it again. I'm looking for companies with market caps under 10 billion, although I'll go a little bit bigger if I need to. But I'm only looking for companies that I think can 5x over the next 5 years. If I don't think it can 5x over the next 5 years, I will not own it in my portfolio. So every single stock that I own right now in my portfolio, I believe has that potential. Now, over time, like Upstart is up 300% year to date, I still think there's a chance to 5x. Now, are they going to 5x from current prices over the next 5 years? Maybe not, probably not, because we've already seen a lot of growth, but they will, in my opinion, 5x from where I was buying the stock, back in December at $40. So, as these stocks rip higher, the likelihood of them 5xing from that latest price isn't as good as maybe 3 months, 6 months, 9 months sooner. But there's still plenty of stocks that I own right now that I think have at least 5x potential over the next 5 years, like Durham Tech and ClearPoint and Desktop Metal and Dario Health. And that's why I just keep loading up on them. So when Upstart goes up 100% and I start trimming my stock or trimming my position, I'm just plowing those shares into those other three companies that I mentioned that are like, I don't expect huge numbers out of those three companies this year. I think the huge numbers are going to come next year. So, I'm overweight in Upstart and FUTU because I think that's where the near term price appreciation comes from. And then I'll trim those profits and put it into the stocks that I think are going to start ripping in anticipation of those big numbers coming in next year. So that's how I move money around.
Got it. I want to ask you a question because I saw you posted about it. Your Q2 FinTwit stock contest is in the final month. I'm looking at the leaderboard right now. Obviously, people with GME, literally number one winner right now is GME, AMC, BB, right?
Yeah, and
Number.
I think the people that won it in Q1 all had GME as well.
So I guess my question is, in the last month of your FinTwit stock contest, what are your takeaways?
That this might be the last time I actually do it. I have a lot of other things going on. I mean, I'll say it right now. I am launching an ETF that is going to happen. So that's going to be in the works. That's going to start taking up a lot of my time and effort. I'm raising capital from investors and from, the original seed capital for the ETF. I'm going to be building the research team and some other things that go along with it. So I just don't think I'm going to have the time to run this stock contest and, to have to go out and find sponsors only to have a bunch of meme stocks kind of ruin it for everybody. I don't know. That just doesn't really make sense. I mean, I'm not going to spend a lot of time and effort promoting a contest when it's just the meme stocks that end up winning it every time. So good chance this is the last time I do it. I went into it with great intentions. It just didn't really play out the way that I would have hoped it did. But that happens sometimes. Now, maybe if someone else wants to take over, I'd consider that, but we'll see.
I might be down.
Okay.
To chat with you about that. I'm happy to help run that type of stuff. Okay, so I got another stock. It's under 10 billion, and that's Redfin. We'd love to hear your thoughts on Redfin right now.
So I actually posted. So interesting you say that. So I posted in my StockTwits room today. And for anyone who doesn't know, I run a StockTwits room. It's $10 a month. I post a lot of my buys and sells in there, my portfolio, my charts, my thoughts and comments, and all kinds of other crap. I'm pretty active in there. I'm like probably 15 or 20 times more active in my StockTwits room than I am on Twitter. So most of my really good content actually goes in my StockTwits room, not on Twitter. But I did post, so let's see, at 11 o'clock this morning, I sent out or posted in my StockTwits room, which also goes out via email. So you don't have to sit on the app all day and hope you don't miss a message. You get the email as well. I said, over the past couple of days, I've seen others on Twitter share their year-to-date performance and current portfolio. I'll post mine in here. So going into today, I was up 73% for the year-to-date. And then I'm up another 4% today. So I'm still doing pretty good for the year. And then I listed out my entire portfolio from biggest to smallest. And then I said, my lowest conviction position right now is Redfin because I'm worried about the sentiment around real estate, not enough supply, the pull forward of demand into 2020, too many agents, mortgage rates going up, and so on. If I had to sell a stock today to raise cash, this is where I would go first. However, with that said, Redfin can do 2.1 billion next year, and at 5 times sales, that gets you to 10.5 billion. or $100 per share, or 77% higher from current prices. So that's why I still own Redfin. So like, I don't love Redfin because of everything I just said in that first sentence. All the concerns about sentiment, and if mortgage rates start to tick up, or like, is there anyone out there that still hasn't bought a house yet? But like, I know there is, because I go to these stupid open houses and I see 50 other people there bidding for these houses. And every time I save a house on Redfin or Zillow, I get an alert 2 weeks later that it's sold for $200,000 over asking price. So there is still plenty of buyers out there. But like, it's great to have buyers, but if you don't have supply, then you can't have sales, then you can't have commissions. And so like, you need both sides. Real estate's a big marketplace in a way. So that's my concern. I mean, I'm not adding to my Redfin position right now, but I have a cost basis of 52. So I don't feel like, now, I mean, if it did pull back, like, I would probably, I'm not going to take a loss on it. So I don't have one set up right now, but I would definitely have a stop loss set up above 52, so that, a winning position didn't turn into a losing position. But I do think this company could do, 2.1, 2.2 billion next year, which I think gets the stock to $100. So, 77% upside in 18 months, I think that's attractive.
Absolutely. And we're about halfway through. I'm just going to take 1 minute, and then I have several other topics that I'd love to dive into. Just for everybody who's listening, obviously, y'all know Jonah. If you're not already following him, you should go ahead and check him out. If you're not getting his write-up, it's one of my favorite ones to read. Sends out multiple write-ups all the time with really in-depth, introductions and analysis to all the stocks we've been covering here. So if you've heard something, I'm getting some people are like, why FUTU, why this, why that? You can get that all from Jonah's write-up. I think you can check the link in his bio. As for myself, my name is Gav Blacksberg, and I'm the COO at Wolf Financial. That's the company I work for. And pretty much my full-time job is being on here, hosting spaces, creating content. I have 6 spaces planned this week, covering everything from stocks to entrepreneurship to startups, to a bunch of different areas. So if you enjoy that type of content, feel free to check out my profile. And of course, if you want to collaborate with other investors, you can check out the Wolf app, which link is in my bio as well. Now, Jonah, you mentioned that you are going to be raising capital for this ETF. I got several people who are curious about the ETF in the DMs, and I'd love to hear more information about that and what that process is going to look like for you.
Yeah, I mean, I'm not even sure what I'm allowed to say right now. I mean, we haven't started putting anything together, but I've had some pretty successful, well-known entrepreneurs in the financial services space reach out to me and say, "Hey, we've been following you for the last year. We love what you're doing. We love your strategy. Your performance is phenomenal. You obviously know how to pick stocks and build portfolios, and we've been reading your write-ups, and you know what you're talking about, blah, blah, blah. So, if you do want to launch an ETF, we'll help fund it, because, it takes a decent amount of capital to start the ETF, just in terms of, like, there's so many legal expenses and custody and marketing and SEC. Like, so basically it costs $65,000 to $80,000 upfront, and then it's going to cost about $20,000 a month, and that's required. That's for just to stay compliant. That doesn't include any marketing expenses or payroll or office or software or research, anything else. So, I'm looking at, let's just call it 75,000 up front, and then let's call it like, 240, 250 a year ongoing. And then I plan on building a 6, 7, 8 person team to start with, maybe 5 or 6 people to start with, maybe a couple more, we'll say, depending on like support and marketing. But that's going to cost a decent amount of money. And I don't want to put in my own money. Like, for anyone that doesn't know my story, I spent the last 5 years and all of my life savings building my last company, which got clobbered by the pandemic. I'm not going to take all my capital and put it at risk again and have to start all over if things don't go well. Not that I expect the ETF to fail or anything, and I mean, it really can. But well, I guess technically it could, if the assets don't come in, then there's no fees or revenues being generated, and then I guess technically the ETF would be a failure. But I don't expect that to happen. So I've had a bunch of different people reach out and say, "Hey, if you want to start this, if it's going to cost you, $500,000 a year in total overhead. I'll throw in 250, right? They'll put in 250 towards the $1 million that I would raise. And, I don't know what percentage of because I have to start an RIA. So I would start an RIA, and then the ETF company would name me or name the RIA as a sub-advisor for the ETF. So anyone that invested in the RIA, would own a percentage of the RIA and then get a percentage of any profits or distributions that we, going forward. So I don't want to get into all the details right now, but I'm 80 to 90% sure it's going to happen. I still have a couple more calls with attorneys and some other service providers and vendors. I've been talking to a bunch of them over the last few weeks. So, I haven't signed any deals. There's no contracts in place, nothing like that. But it definitely looks like it's probably going to happen. It's probably going to take a good 6 months to get everything wrapped up. So, we probably end up launching it, if all goes well, maybe late this year or early next year.
Any ticker ideas?
You can be sure that pretty much all the stocks I own right now in my portfolio will be going into that ETF.
Oh, so. No, I meant for the ETF.
Oh God, no, I have no idea. I haven't even started thinking about names. I'm like 90% sure it will not be called Lupton Capital. I don't like people that name their funds after themselves. I just think it's an ego move. And I wouldn't want to work at a firm that was named after someone else. So it'll be like a totally different name, but I honestly haven't even started thinking about that or the ticker. But in terms of strategy, it will be essentially the strategy that I run right now. Let's call it multi-cap growth, with a focus on small and mid-cap stocks. Right now the average market cap in my own portfolio is around 4 billion. I think for the ETF would probably be a little bit bigger than that, probably 6 to 8 billion. So there would be a mix of small cap, large cap. Probably wouldn't find too many stocks over 20 billion, but you might get a couple. Like a Palantir or a Roku or some of those. Even a CrowdStrike. So there might be a couple 30, $40 billion stocks in there. But I would say the average market cap or the weighted average market cap would probably be somewhere between 6 to 10 billion.
Got it. Very cool. I'm looking forward to that coming out. I was doing a space last night covering the cannabis industry. I'm wondering if there's any small cap cannabis companies which you have done any research into.
So the only one that I don't think it's not really considered a small cap anymore, but the only one that I own right now is Grow Generation, ticker symbol GRWG. So that's a 2% position in my portfolio. The chart looks pretty constructive right now. Stocks had a decent pullback from like the mid 60s down into the low 40s. They've been doing a ton of M&A across the country. I don't think I've ever owned. Yeah, it's small deals. They're going state by state and buying, other existing operators, that might have 1, 2, 3, 4 stores, but it's a faster way to expand nationally and get the licenses you need and whatnot. If there's already an established player in a market, it doesn't always make sense to go in there and try to become a new player, and then you're competing head to head with the established player, and then you're just beating each other up on margins and discounts and everything else. So in this case, I do like the strategy of going out and acquiring existing operators with, proven track records and the licenses and all of that. The stock's had a nice run from last summer, so it's not a stock that I'm adding to aggressively right now, but I do want some exposure to cannabis in my portfolio, and that's my favorite stock right now. That might change once Weed Maps gets through their SPAC crap. So Weed Maps, which is ticker symbol SSPK, is coming towards the end of their SPAC merger. Once they de-SPAC and start trading under their own ticker, which I think is going to be MAPS, if I remember correctly, that might be a stock that I either move into, sell, grow, and move into Weed Maps, or possibly sell maybe half of my Grow Generation position and then put half, some of the proceeds into Weed Maps. Those are pretty much the only two that I follow in the entire cannabis industry. I don't follow any of the the growers or the brands. I just think it's too hard to pick a winner. In this case, this is like the traditional picks and shovels approach. Grow Generation is trying to be the Home Depot of cannabis, and that's why I like them. And then they announced yesterday that they're really pushing harder into e-commerce and buy online, pick up in store. So they're getting there.
Yeah, I had one of their actually a manager for a Grow Generation warehouse came onto that call last night. Was chatting a little bit about their operations and stuff, which was interesting to hear from. Let's dip back real quick into Upstart. So Upstart ran up to 170, I thought, but I'm seeing 166 is the highs. I don't know. Robinhood's weird. And now they're sitting back at 148. They're actually up. They shot up 4%, almost 5% since we started the space. Yeah, 5% since we started this space over the
Yeah.
last 40 minutes. So
I'm
you sell at the goal is right to trim at the top, buy on the way down. What's your thought pattern with Upstart here? Where are like the ranges where you would recommend or not recommend, not financial advice, but like you would be buying more?
I mean, I bought more this morning. So, I sold, like I said, I sold a third of my shares, or 30% probably. I haven't gone back and actually counted share by share, but my guess is probably about 30% between probably like 155 and 170 or 171. I think I did sell a very small chunk at like almost the exact high. And then I started buying the stock back when it got back below 150. I started buying some of those shares back, and sort of the exact same thing in reverse order. So, you put in all these limit orders, so for every $2 the stock moves up, I'm selling 2% of my position. I do the same thing on the way down. Once I decide I'm going to start adding a stock back, so I'll set up some limit orders at 150, 148, 146, 144, and so forth and so on, and start buying back the stock that I sold higher. Because I have no idea where this stock is going in the short term. Upstart has a mind of its own. There's clearly been some big institutional buyers that have been coming in. The stock doesn't go from the low 80s to the 170s with retail alone. So clearly there were some big institutional buyers. We know that Dan Loeb was one of them. He's already come out and said that he was buying over the last few weeks. For anyone who doesn't know, Dan Loeb, he runs Third Point Capital. He actually invested in Upstart's C round. So their Series C round, I think, I want to say like 2015, maybe 2016. Can't remember. But he invested in their C round at a $120 million valuation. Now the market cap is, let's call it 12 billion. So that is a ridiculous, return on investment, but he's still buying. Like, that just shows the conviction that he has 6, 7 years later with the stock. The valuation goes from 120 to 12 billion, and he's still buying the stock. And, let's not be naive here. Dan Loeb knows what the company's doing. He has access to anybody to company that he wants. When someone like that, that much like inside knowledge is loading up on a company, that makes me feel pretty good. He knows where what the company's strategic plan is for the next 6 months, 3 years, whatever. Like, I'm sure he's got a pretty good idea of what credit verticals or credit markets they're getting into next. They started with personal loans. They're now getting into auto loans. I don't think Dan Loeb would be buying, literally, I think he bought like $1 billion of Upstart this year. I don't think he'd be buying that much Upstart if he didn't think the stock was going up another 5x, 10x, 20x. So I mean, like, should the stock have gone from 81 to 171 in a week? Probably not. But should it have been at 81 in the first place? No, of course not. They reported phenomenal Q4 numbers, and then they followed up with even better Q1 numbers, raised guidance from 500 million to 600 million, and that's probably conservative. And that doesn't even include any contribution from the acquisition of Prodigy, which now gets them into hundreds, if not thousands, of auto dealers. So, I don't know, like if the stock goes back to 170 tomorrow, I'd probably start trimming again. And if it pulled back below 150, I'd probably start buying it again. So like, I guess that's my range, like over 170, I'd probably start trimming again. Under 150, I'm a buyer, and that's why I was buying the last few days as it, dropped below 150. And then I think today it got down to like 142 or 143. Actually got down to 138. Yeah. I can even tell you completed orders. So 142, 142.50, 143, 141.50, 141. So those were all my buys on Upstart today.
Got it. Got it. Awesome. Yeah, I was definitely curious about that. Also, SOFI has officially de-SPACed. They're trading under their ticker. They're having a pretty nice first day. They were up 10% almost, and now they're up about 4.7%. I know we've chatted in the past, and you stay away from SPACs mostly, but you were semi-fond of IPOE. Any thoughts on them now that they've de-SPACed? The market cap is still just around 2 billion.
No. Market cap's like over
Oh,
20
is
billion.
it over
Yeah,
20? Okay, they're
that
reporting it wrong then on here.
well, that 2 billion is probably what was in trust.
Oh, okay.
Well, the 2 billion is probably like, so the stock, if the stock is showing, so 23.68, right? And they're, like I'm seeing a market cap of like, 2,382,000,000. So it was probably, I don't know for sure, but $1 billion SPAC. And because the stock has moved from $10 to $23, it looks like the market cap has moved from a billion to 2.3 billion. But that's just the appreciation of the, the value of cash in the trust. So, yeah. I wish the stock hadn't taken off. I mean, it is sometimes hard to know what these SPACs are going to do before they de-SPAC. Although I have said that the SPACs that have held up the best and are trading in the mid to high teens should act much better after they de-SPAC than the stocks that are trading around 10. The SPACs that are stuck around 10 are only stuck at 10 because there's that, that $10 redemption, and that creates the floor. If there wasn't that $10 redemption, some of those SPACs would probably trade down to $7, $8 before they de-SPAC, but they won't because of that floor, that redemption. But if those SPACs are still stuck around $10 when they de-SPAC and you lose that floor, that's where I expect those stocks to go lower. So, whether that's TSIA or Fuse or SBG or AHAC, AACQ, like all the ones that I'm looking at closely, I expect most of them to drop below 10 when they de-SPAC, probably down into the low nines, maybe even into the high eights. And that's when I would consider, starting positions in those stocks. For the other SPACs that are trading, like I said, in the mid-teens, high teens, even the 20s, like SoFi was, like GHVI, SSPK, ACTC, like a bunch of others, CCIV, like those things are trading on their own. Like they're clearly trading on the fundamentals more than anything else. So, to be honest, I'm sort of disappointed that SoFi took off because I was planning to start a position, but I wanted to see a pullback, and it just hasn't happened. I mean, it's gone from like 18 to 24 in the last week or so. Now, if it got back down below 20, I'd probably start a position. I don't think I'm going to chase it up here.
Got it. And Jen, I want to be respectful of your time. I know that you probably just have a few minutes left, right?
Yeah, I could go till 2.
Okay. So I similar question to what we did for Upstart, and that is for FUTU, kind of, where is the buy range? Where's the sell range? They're down 5.23% currently to 142 right now. But they do these bumps between really like 100 and 150 pretty often. So just kind of understanding where your buys and sells are coming in.
So I actually trimmed about 5% of my FUTU yesterday after hours at 150 because the position was just a little bit too big for my portfolio. And then I actually, no joke, I actually bought back those shares today around 140, 141. So I think in the low 40s, FUTU was still a strong buy in my opinion. I would have bought even more this morning if I had more cash in my account. and if it wasn't already one of my top 2 or 3 positions. So I got no problem adding to FUTU in the low 140s. I interviewed the CFO yesterday of FUTU. Unfortunately, because I'm a moron, I didn't record it. I thought Zoom automatically recorded all of my webinars. They always have. For whatever reason, this one did not get recorded. So I don't have that interview to share with everybody yet, but hopefully the CFO, his name's Arthur Chen, will give me another chance, because it was a really, really good interview, maybe one of my best, if not my best. So he laid out a really, really bullish situation / strategy for FUTU. So, I mean, we all know that they are crushing it right now with their user growth, asset growth. And I wanted him to confirm that, they have the ability to keep that going. And it sounds like they're definitely going to have the ability to keep it going as they expand into new markets, new products and services. So they're already seeing phenomenal growth in Singapore. They're seeing great growth in the US. They just launched a new ambassador / referral program today, actually. They're getting into crypto. So second half of this year, probably either late Q2 or early Q3, we'll see them launch crypto for their Moomoo app. So FUTU is like basically 2 different apps. It's FUTU Bull, which is their app for mainland China and Hong Kong, and then Moomoo, which is their app for outside of China, so Singapore, US, and any other markets they get into. They're also seeing huge growth from their wealth management stuff. So they launched wealth management last year. That's going really well. That's appealing to a more affluent, clientele that basically wants to have their capital managed for them rather than them doing it themselves. And they said that they're going to launch more products and services for those people. He kind of hinted that they could be getting into insurance and mortgages and all sorts of other financial services. He said that they did that $1.4 billion stock offering about a month ago, so that they could issue even more, have more capital requirements for margin financing, because it looks like FUTU has a bunch of debt on their balance sheet. He confirmed that they have 0 long-term debt. Any debt that you see on their balance sheet is short-term debt. It's basically because they have to borrow that short-term debt from banks in order to facilitate the margin requirements, the margin borrowing for their customers. And as they increase their margin to customers, they need to have more, capital. And that was part of the fundraise, but also to continue expanding to other regions in the world and roll out new products and services and spend money on R&D and product development. And then he also said they could see some acquisitions in the near future of other fintech companies that would accelerate their ability to get into a new region or a new product and service or whatnot. So I'm still super bullish on FUTU. I think the estimates for this year and next year are still way too low. I think there's a good shot they do 1.2 billion this year in revenues, and then I think they have a shot at, I think, 2 billion next year. Let me just look at my numbers. Hold on. So my projections, my model, I have them at 1.2 billion in revenues this year, 600 million in earnings, so 50% net income margin. Next year, I have them at 2 billion in revenues with about 960 million in earnings. So a slight tick down on net income margin, but that wouldn't be surprising if they're really growing this fast and investing capital in growth and customer acquisition. So, I forget what number I use. I think like 45, 46% net income margin. But anyways, like if you take 960 million, and I think I threw on like a 50 PE multiple, which would be pretty cheap for a company growing this fast with these margins. But, you throw a 50 PE on 960 and, you run all the math, and basically, so my price target for FUTU by end of next year is about 330, which is about, more than like 125% upside from here. So, I mean, that's why it's my biggest position right now is I don't see a lot of downside to this company, just because they have the fundamentals are so strong, and I see 120% upside over the next 18 months. So
would you be open to taking leaps on it?
I just don't do leaps. I've never bought a leap in my life.
Got it. You'd rather do the kind of the shorter term.
Yeah, yeah, yeah. So like,
Okay.
I mean, right now my only call options are for Durham Tech, because
Right.
I'm expecting an insurance announcement in the near future, and with that 33% short interest rate now on Durham Tech, I mean, if you get an announcement from Cigna, United Health, Blue Cross Blue Shield, because there's like 35 or 36 Blue Cross Blue Shield organizations that are all part of the federation, and there's only a few of them that have come out in support of Durham Tech. We could see several more very soon. If any of those things happen, not to mention that Durham Tech is rolling out Luminate at some point later this year. Once we get more information on that, that could definitely move the stock price. So there's a lot of like catalysts that could come through in the next 3 weeks, 6 weeks, whatever. And if any of them happen, I mean, this stock could rip 30-40% in the blink of an eye. So
Got it. Let's talk about earnings for a second. I know that I'm sure you know that CrowdStrike earnings are tomorrow, but are there any other earnings kind of on your radar over the next week?
nope. I can't think of any. I mean, nothing that I'm watching.
Got you. Yeah. One question that I did have, I don't know if you follow them at all, reported earnings this week is Zoom, and just kind of your thoughts on Zoom as a stock.
Yeah, I mean, I haven't owned Zoom in 8 or 9 months probably. I forget when I sold it. I think I sold it in like October maybe, in the 400s, 400s to 500s. I can't even remember. I thought the valuation was getting a little stretched at the time. I think the market cap was 150 or 180 billion. I forgot how big it got, but I mean, I think most of us knew that growth wasn't going to be sustainable. The growth that they saw in 2020 would have to start slowing down. But I mean, they're now becoming a more mature company, and there's nothing wrong with that. So multiples have to come down, and so the stock price has to meet the fundamentals. That's what we're seeing right now. I mean, we saw the same thing on a lot of other of these 2020 winners, Peloton and CrowdStrike and many others have pulled, Snowflake, the growth that they saw last year, it was phenomenal, but it wasn't sustainable. And the multiples moved up so much that as that growth slows down, the multiples have to come down too. I mean, that's just how it works. So, I sold some of those stocks a little too early and some a little too late, but I think overall I was probably correct that, a lot of them had to pull back. Now I think Zoom is maybe $100 billion company. And I think I mean, you might even know better than me. Was it 4 billion in revenue that they were projecting for the next year?
I wish I looked closer. I have not looked at it yet.
Yeah, I mean, I didn't watch the earnings come through. I didn't listen to the call. I'm only going off of what I've seen on Twitter. Obviously a lot of people on FinTwit still own Zoom, so they're posting numbers. Yeah, so I mean, I'm looking at the CNBC app right now. It says market cap's 95 billion. For some reason I have 4 billion in my head for revenues. So, I mean, quick math, 25 times sales. I mean, that's not cheap, but I mean, they're still putting up really strong growth. They're profitable. I don't remember if they've been added to the Nasdaq yet. If not, they should be pretty soon. So we could get that catalyst as well. So, I mean, I think the stock is interesting in the low 300s. I'm not a buyer because, like I've said, I mean, I'm just not into these $100 billion market cap companies anymore. Obviously, ARK Investments is still a huge buyer, believer. Um, yeah, it looks like Zoom's forecasting about 4 billion for the next year, so about 51% growth. I mean, that's let me see, what are they earning? So they're supposed to earn. I mean, the margins are phenomenal, right? I mean, looking at net income margins projected for the next year, 35% net income margins for a company growing 51% is still pretty freaking good. So, if they're going to earn 1.5 billion in profits over the next year, um, I mean, 63. I mean, that's not crazy. I mean, 63 times earnings for a company growing 50%, and they're still like in the early days of growth. I mean, this is a company that 4 billion next year, 5 billion the year after. I mean, this company in 4 or 5 years. I mean, this could be a 7, 8, 9 billion dollar revenue company. And
Hmm.
I was watching CNBC today, and one of the early investors was on talking about his why he's so bullish on the company still, and it's all about this platform. Just like Apple has iOS and Google has Android or Google Play. Zoom is building out this platform that other companies will be able to plug into, build apps for, etc. So how they monetize that, I have no idea. I don't know the company well enough, but I mean, I can see if I can see where that would be another revenue driver going forward. Just like Shopify, has their app store. They generate a significant amount of revenue from that app store. It sounds like Zoom is kind of following that path. So I mean, I don't know, if I was investing if I was a large cap growth manager, I would not have any problem buying Zoom in the low 300s.
Got it. And then I have one thing to end on before I do that to everybody. I have, like I said, a ton more spaces planned out over the next week. I just posted about my space that's going to be tomorrow, featuring entrepreneurs, startup people. So it's going to be really, really good. I'm going to put out an RSVP link for that soon, which is the space RSVP. And then, of course, obviously, me and Jonah are at it every single week that we can be. So I'm sure we'll run it back hopefully next week. But Jonah, my last one that I wanted to end on is actually digital Turbine apps. Killed earnings, did a great job, but they're down 6% today. Just your thoughts on apps right now.
I mean, it's not a stock that I own right now, so I don't follow it super close. I mean, I saw a few people. One person posted, "Hey, it looks like the revenue numbers are better than Upstart," but they also did at least one, if not more, acquisitions in the quarter to add some of that revenue growth. So it wasn't all organic versus Upstart is all organic. So Upstart's growing at 160% year over year without any acquisitions. I forget the exact number that apps grew year over year. I want to say it was in the 140s or 150s, but a chunk of that was an acquisition. I saw someone post that the true organic growth number was 95% year over year, which is still a phenomenal number. I don't know if that's sustainable. I don't know the company well enough to know. I know that gross margins are not fantastic. So when people wonder why the multiple is so low, it's because of the gross margins and the gross profits. So I don't know. I mean, I've never been a big fan of the advertising platforms like apps. I don't know. I mean, I'm just always afraid, and I'm gonna say stuff I don't even know, but I feel like these platforms, iOS and Google Play can change things so quickly on you and really screw advertisers over in the blink of an eye. We're sort of seeing that with iOS right now, where every time you download an app, you basically have to like give permission for tracking and ads and everything else. And I don't know how that would impact apps going forward if Google did something similar. So I don't know. Maybe that's where the discount is coming in from. I don't know. To be honest, there's other people on Twitter that know this company a billion times better than me that can give you some better answers. Like I said, it's not a stock I own, so it's not a stock that I track very closely.
Fair enough. Fair enough. All right. This one was recorded. Got my intern on here recording this space, so hopefully I'll try to have this up within the next 24 hours. As always, doing my best. Jonah, really appreciate you taking an hour out of your day. And
Yep.
we'll hopefully run this back next week. Yeah?
Sounds good. Okay.
Awesome. All right. Take care, man. Enjoy the Celsius.
Have a good one. Bye-bye.
All right. Thank you, everybody, for listening. Like I said, more spaces coming in soon. Take care, and I will chat with y'all later.